Thank you. It's a pleasure to be here in Alice Springs today for my first visit, and many of yours, it seems. Just to start off, I joined Lazard Asset Management in 2001, where I'm a global equity portfolio manager and a managing director. And I need to give you two health warnings. Number one, at Lazard, we've purposely chosen not to have a global chief investment officer who dictates views to the entire firm. Our view is we want people to be bottom-up, long-term, active investors, and we want them to operate independently in their own portfolios. So that being said, the views you're going to hear today are my views and my views only. They do not represent the firm or my colleagues. Now, number two, markets and the macroeconomy are two completely different things, and I'll summarize that with one anecdote. Since 2007, the Chinese economy has grown 160%. The Shanghai Stock Index is down 60%. So if we invest purely on GDP trajectories, we might end up being quite unhappy. And having said that, though, I want to talk about the macroeconomy. We'll try to tie that back to what it means for you and for asset allocation. So the two topics I've chosen to address today are basically the US and China. And I really want to think in terms of 3 to 5 year views. Again, we're trying to be a bit longer term. And I chose those two countries because I think the consensus is wrong. In the case of the United States, I believe there are 3 primary themes we need to think about that do put a limit on growth, although I would definitely disagree with Jim that we are not in a depression in the United States. I think the problem with his definition is he's assuming potential GDP growth is 3 to 3.5. I think 2 to 2.25 is actually potential GDP, which is exactly where the US is, and 2% is the number I expect for the next 3 to 5 years. Now, the reason I expect that number is those 3 themes. Number one, deleveraging. We have a lot of work to do. Number two, re-regulation, the financial sector, the healthcare sector, the energy sector, much of which I think was incredibly warranted after the crisis. And number three, widening gaps in society in terms of wealth and income, which again has an effect on growth. Now, I'm going to review all of this data, and the way I'm going to approach it is to show you data that would seem to imply that the US economy in aggregate is actually even stronger. Because I think the consensus right now is the economy's done well, we're 5 years into a rebound. When does the Fed start raising rates? I disagree with that view, but I do think it's a good economic recovery, just not a great one. In the case of China, I believe investors have been lulled into a false sense of complacency by many, many years of meticulously managed GDP numbers. I think the debate over whether China will grow at 6% or 7% is the wrong debate. The debate over the next 3 to 5 years should be, is it 4% real growth or is it even slower? And the 3 reasons I think that's the case are, number one, a lot of the competitive advantages that led to China's growth for the last 20 to 30 years have dissipated. Number two, working age population in China is going down. Last year was the first year that they saw negative population change for the working age, and that has an effect on growth. And number three, there is an enormous pile of leverage accumulating in China trying to make up for the first 2 factors. I don't see a catastrophe in China, and this is very important. This does not mean run for the hills from emerging markets. But what it does mean is there will be challenges for Chinese growth that will affect commodity prices, as well as the countries that export commodities in a negative way, and frankly, in a positive way, countries that import commodities, and there are quite a few of them. So I always like to start with this map to give you a sense of what the consensus view is. What I've shown you is 2013 GDP in US dollars, and then 2014 and 15 consensus. I mentioned I'm a little less optimistic than the market on the US at 2%. Clearly on China, I think the trajectory should be a more steeply negative trajectory. So you can use this as reference later. Now let's start with the US. I mentioned 3 key themes, number one being deleveraging. Now, I think it's very important is the US has made a lot of progress since 2009. What I'm showing you here is actually private sector debt divided by GDP. So think of it as the total amount of debt relative to the national income for the private sector. Now, I would argue part of the reason I disagreed with that 3 to 3.5 potential GDP growth is from 1980 all the way through to the financial crisis, what you see on that chart is a massive ramp up in leverage. I think many economists and many market forecasters misinterpreted the economic growth we saw from 1980 to 2000 as being sustainable core growth. When you think about growth, it's really a function of population growth, productivity growth, and you could add a third variable, which is your ability to borrow against the future population and productivity growth of your country. In the US, Europe, and in many other countries in the 1980 to 2005, 2007 period, we borrowed against future income, our economies grew above their actual sustainable rate, and now we're paying back for that. To me, what's encouraging here is we've taken 56 percentage points off of that debt to GDP ratio in 5 years. Now, the negative point is, if you look back in history, you can see in the Great Depression, debt to GDP peaked at 230%. Entering the Great Depression, debt to GDP was 155%. The reason it went up so much is GDP collapsed, and you were dividing debt by a much smaller number. So my point here is I think the current level of debt is sustainable at current interest rates. But when the Fed actually does start to raise interest rates, because they see, for example, a very strong GDP print or they see good jobs numbers, that by definition will almost make the next readings on jobs and GDP less good. So I think there's a bit of a lid on growth that the US will have to deal with because of this pile of debt that we have to keep working on. If I add the public sector, the story's less good. Instead of a 56 percentage point decline, it's a 26 percentage point decline. And again, positive progress, but a lot of work to do on deleveraging. So that's the debt side of the balance sheet. Let's look at the assets. And this is, again, back to the stats that make the economy look stronger than it might really be, because aggregate statistics can be dangerous. You might have heard the expression, you can drown in a river that's an inch deep on average, right? So we always have to try to deconstruct these numbers. And what you see here is household net worth in the United States is actually 19% above the pre-crisis record as of first quarter of 2014. That represents a $26 trillion increase in net worth since '09 to $82 trillion. Now, if we look at the composition of that net worth, 21 trillion of the $26 trillion increase has actually been financial assets. So if you think about your own balance sheet, you own some physical assets, which is probably your house and your car being the biggest ones. And then most of the rest of, well, if not all of the rest of what you own that's really of value, that's notable, other than maybe jewelry and fine art, is going to be financial assets. Now, 21 trillion of the 26 trillion, or over 80% of the improvement in financial conditions for households, has been those financial assets. Only 18% of the increase in net worth has been housing. And this is important to deconstruct as well. There's been a $4.7 trillion increase since the beginning of 2012 in the owner's equity in housing. So this means the value of your house minus the mortgage against it. Now, 3.5 trillion of that 4.7 trillion has been home values going up, and 1.2 trillion has been a reduction in mortgage debt outstanding. So the reason I care about that is every 3 years, the Fed goes through the US and does a deep dive survey of consumer finances. And they put out a 1,300-page book, which came out last week, so we're very lucky we had the new data, and they stratify households on a range of criteria. I like to look at households ranked by net worth. So what you see on this screen is 4 columns that divide the 123 million households in the US into the bottom quarter, the 25th to 75th percentile, the 75th to 90th, and then over 90th to 100. So let's focus on the far right column. What you see there in the bottom right cell, you can see 12.3 million households. And what you see is thousands of dollars, by the way, for each line. So average assets in 2013 for the households in that column was $4.25 million. With about $240,000 of debt, that means the average household in the top decile in the US by net worth had just over $4 million of net worth. That was a record high for net worth for that column. What's also interesting is if you look at the pie chart, and I'm sorry one of the numbers has disappeared, the dark blue is financial assets, which is 45% of that cohort's entire asset allocation was financial assets. 25% in light blue is also a financial asset, but I've broken it out because it's ownership of unlisted businesses. So for the top 10% of Americans, 70% of their assets were financial assets as of last year. The gray part of the pie chart shows you their home, which is their primary residence, was only 16% of their assets. Go over 2 columns to the left where you see the blue box around the column. That's the 25th to 75th percentile. I describe that as the middle class in the US. 61 million households with an average assets of $180,000, $73,000 of debt, $107,000 of net worth. To put this in context, I said the richest 10% have never been richer. This middle class cohort saw that their net worth went down 25% since 2007. They had net worth on average of $142,000 before the crisis. Why did they get hit so much harder? 60% of their assets were in housing. And if you do the math quickly, $180,000 times 23% of their assets in financial assets means on average the middle class only had about $41,000 in financial assets. And again, just to put this in scope, that includes your deposit account at the bank, your life insurance, your pension plan, your retirement plan that you've done yourself. All of those financial assets worth $41,000. And by the way, if I look at equities, either directly held or indirectly held, the average household in this middle class had $15,000 of equities. So the fact that the S&P has tripled since 2009 is really nice, The problem is over 90% of all financial assets in the US are owned by the top quarter of the country, the two columns on the right. And by the way, over 95% of all the business equity in the US is owned by those same two columns. So when I mentioned at the beginning deleveraging as a headwind for growth, I mentioned re-regulation as a headwind for growth, and I mentioned widening gaps in society. This to me is not only a social issue, which I think is important, but it's an issue of the ability of the US economy to grow. And by the way, it's not just the US that has this issue, but we have the data to show it more clearly. So I think one of the biggest challenges we have in the US is if you look at that massive market of the middle class, I tend to think of horses pulling a wagon. Those horses are dragging behind the wagon still because their damaged balance sheets have not recovered. And to that second theme of re-regulation, even though housing values have gone up $3.5 trillion in the US, the majority of that value accretion has been to the two columns on the right, where house prices at the high end have gone up the most. And part two of that is because of re-regulation. Even if your home value has gone up in the US, because of Dodd-Frank financial reforms, which I think were warranted and necessary, and because of Basel III, banks are unwilling to lend against homes for consumption like they did during the bubble. So again, this is very important in terms of the balance sheet context. Let's switch gears to the income statement. Because the other thing that could make me wrong in terms of economic growth would be, even if people don't have a better balance sheet, if their wages go up or they get a job, clearly they spend more money, especially in the middle class. Now, the good news is the US did lose 9 million jobs basically in the private sector during the crisis. We've regained 10 million of those jobs since, so that's been nice. The only challenge is the US population has grown by about 15 million people during that period of time. So it looks like you've caught up, but you haven't, which is why I like to look at this chart, which is the employment to population ratio. And what this shows you is the percentage of adults who are working. And what you can see is before the crisis, back in December of 2006, 63.5% of Americans who were adults were working. As of the last month, 59% of American adults are working. Now, if I take that against a 250 million person civilian labor force, or adult population, what I find is 11 million jobs would need to be created for the US to truly be back at full employment. Now, that would argue to me, if I'm sitting in Janet Yellen's seat, I look at the middle class balance sheet and I say, okay, these people can't spend like they used to. That's a lid on growth. I've got deleveraging the public sector and private sector still ahead of me. That puts a lid on growth. I've got this income statement issue. That puts a lid on growth. So this, to me, is one of the reasons why the market expectations for the Fed to start raising rates in the first quarter or second quarter of next year is too aggressive. Now, sadly, because of all the statements we're hearing from the Fed lately, and to Jim's point about Plosser and some of the other Fed governors who are extremely hawkish, in my view, to an unwarranted degree based on ideological principles, there are people who think the Fed should have started 6 months ago. What I'm hoping will happen is that maybe they will delay tightening until the second half of next year, or if we're lucky, into 2016. Now, one more clarification. That 11 million jobs is a little oversimplified. America's aging, and because of aging, we've seen that about 4 million jobs are disappeared because of people retiring. So I can explain part of this with disability, I can explain part of it with demographics, but either way, I end up with a situation where the United States actually still has quite a bit of room to go to recoup the lost ground from the crisis. Now, if I switch gears to China, it's a very different story. It's odd to sound bearish when you say real growth of 4% might be a bad scenario, but what really troubles me about China is I think that there's an intellectual complacency. I think a lot of people have just given up on trying to predict when China will slow down or by how much, because it feels like the government can pretty much print whatever number they want. And oh, by the way, they can. It doesn't mean the reality of the economic growth is what the number is. If we want to give one good anecdote here, if you add up the provinces of China, the 31 different provinces, if you add up their GDP, it's 15% more than China's GDP. So the numbers in China literally don't add up. So that's one problem already. But if we're thinking about 7% real growth into the future, I like to show this in terms of the law of large numbers. If you look from 2008 to 2013, China's economy grew by the size of today's Russia, Mexico, and South Korea combined. If you believe China from 2013 to 18 will grow by 7% in real terms, with 3% inflation, that means China will grow by a Germany plus an Italy, or if you want to put it differently, Japan plus half of Australia. Those numbers are mind-boggling, and in and of themselves should cause us to question what's driving this growth. Now, when I think about what drove this growth for the last 30 years, one of the first things I think of is labor was cheap. If I were Jack Welch at General Electric in the US and I wanted to either build a factory in Kentucky or a factory in China or in Mexico, I would look at data like this on the chart here. You see the light blue line at the far left that's at the top? That's the average monthly cost of hiring a worker in Mexico, which in 2001 was $400. I like to think of this in dollars per hour, so it's $2.40 per hour. Go all the way to the right end, and you see Mexican labor has gone up to $3.30 an hour since then in 2013. Now you can see the dark blue line at the top right is Eastern China. Back in 2001, Eastern China, labor was around 80 cents an hour. Now it's around $5 an hour. In 2014, it's likely to be $5.50 to $6 an hour on average because the CAGR has been 16% a year. China in aggregate is basically running at a level over $5 an hour in total for this year. So if I'm sitting at General Electric today and thinking about the next factory I want to build, the question becomes more one of, is it Mexico or is it the Philippines or Indonesia? Not, is it China? This, to me, is one reason to think growth will slow down. Now, if you say to me, well, wait a minute, we all know wages have gone up. They're just going to move the jobs to the interior. You get the textiles being done in the interior. You do higher value add on the coast. I'd point to this one. We looked at the wages in all 31 of China's provinces. And we went from the most expensive province, which is Beijing on the left. And what you see there is in Beijing, the average person makes about $7.50 an hour. Interestingly, and very different from Australia, the minimum wage in the United States is about $7.25 an hour. So if you're building a factory in Alabama or South Carolina where there aren't many union members in the US, you can actually hire people close to the price of hiring people in Beijing now. Now think about what's happened in Italy and Spain, Portugal, Greece. Beijing and the expensive parts of China are now competing with developed markets, not emerging markets. Go to the minimum province, the cheapest province of the 31, and it's still more expensive than Thailand, Indonesia, and the Philippines. So my point here is I think China's hitting some elements of a two-pronged problem. At the top end, they're too expensive to compete with developed markets because they really don't have the intellectual value added that you get out of Europe and the US and Australia. And at the bottom end, they're competing with the EMs that are cheaper. And frankly, where logistics of getting something from the port in the Philippines to the United States or Europe is a lot easier than getting it from inner province of China. Now, the second item I mentioned before was demographics. What I've shown you here is the 5-year average growth rate in working age population. These are United Nations forecasts. Because it's 5-year, you're not seeing that 2013 number I mentioned, but population growth actually started to decline last year because of the one-child policy. And the yellow line basically shows you the percentage of the dependency ratio, which takes the number of people 0 to 14 years old and over 65 and says, okay, what's that divided by the number of people who work between 14 and 65? And again, you see that there are basically more people being fed by the work of others, which is also going to be a drag on growth. Now, what's China done to deal with all of these issues? And again, this is oversimplified, and we can dig into it more in Q&A. But the biggest thing I've seen in China in the last 5 years is replacing real economic competitive advantages with leverage. It's a movie we've seen in the West, and now we're seeing it in China. So what you see here is debt to GDP since 2008, where it was 155%, has gone all the way up to 238% in 2013. But what I want to focus your attention on is the dark blue part of that bar and the gray part just above it. That's basically the small businesses in gray and the mid and large corporates in dark blue. If you add those two up, from 2011, you can see debt to GDP for that sector, the corporate sector, has gone from 136% to 168% of GDP. That's not the end of the story. GDP grew about 10% a year in those 2 years because you need to look at nominal GDP. This means in 2 years, the debt for corporates in China has gone up 50%, 5-0. Now, why would corporates take on so much debt in an economy where growth is slowing down? They're doing it because they're not competitive anymore. And one of the challenges in China is for the last 20 to 30 years, a big part of the growth story that I didn't mention yet was misallocation of capital. Chinese banks, or in general, the big ones, are majority state-owned. Who are their favorite lending counterparties? State-owned enterprises and local governments. I think what you're seeing is that the policies in the banks and the financial sector in the past, and even today to some degree, have not been focused on return on capital. They've been focused on other policy goals such as growing GDP and growing employment. And the problem is going to be over the next 5 years how China figures out a way to deal with higher wages, a shrinking working age population, and all of this debt at the same time that they've now created excess capacity across a range of industries, which is leading to their producer price index having been down 29 consecutive months. So when I look at China, I just want to reiterate, I'm not saying that we're going to have a catastrophe. I just think that we should all be retuning or recalibrating how we think about the future for China in terms of growth. It should be a question of what does it mean if it's 4% real growth? What would it mean for asset prices in China? What could the contagion mechanisms be to other countries? I mentioned commodity prices, but they go beyond commodities, and we can talk about that more later. But I also think there's an interesting point here is what it means for investing in emerging markets. If there's a single theme I think is important in emerging markets over the next 5 years, it's differentiation. You have some countries that have basically hitched their wagon to selling commodities to China for the last 10, 20 years. First one I tend to think of is Indonesia. I'm being polite because I'm in Australia. The second category of countries I think about are the ones actually who suffered. Imagine you're in Central and Eastern Europe and you import almost all of the commodities you use to produce goods. They've gone up so much in the last 20, 30 years, partly because China was the gorilla in the room. So there are going to be winners and losers. Mexico is a great example of a winner, I think. So I think what's really critical as you invest going forward is to be active in emerging markets and make sure you know which companies and countries you own. Now, if I could wrap it all up in one more thing. If I'm right in terms of my view of the US with a 2% real growth rate on average for the next 3 to 5 years, and with China decelerating, and again, we can touch on the Eurozone and Japan during Q&A, what that means for all of us as investors is two things in particular. One, I think interest rates are likely to stay lower for longer than people expect, and when they finally do start going up, I think they will go up less than people expect before they stop going up. Put a different way, the Fed might start raising rates next year, but maybe instead of stopping at 3.5% or 4% like all the historical models suggest, maybe rates stop at 2%. That means if you're thinking about your ability to generate income in a portfolio, it's still going to be a challenging environment, especially when the ECB just announced €1 trillion of what's effectively credit easing / quantitative easing. I do think there are good investment opportunities to deal with that, including active selection of emerging market debt and global equity income portfolios that can tap into companies that pay high dividends and can grow those dividends. The second issue would be capital generation. How do you generate capital gains in your portfolio or capital appreciation in such a low growth environment? I think actually one point is 2% real GDP is not the end of the world if you have 2% inflation, which means 4% nominal GDP, which arguably means 4% revenue growth. With operating leverage, with capital management, you can easily get to a 6 to 8% earnings growth in that kind of environment, which means 4 to 6% real returns, not so bad. But I do think where you actually might be able to do even better than that is approaching it again from an active perspective. And I appreciate Angela's comments earlier about active versus passive. Actively by way of concentrated portfolios, whether it's US, global, or non-US, there are many ranges, there are choices. Small cap portfolios where you tend to get opportunities to capitalize on growth. And then I think also you can take advantage of it again through emerging market equities, taking advantage of that differentiation between winners and losers.
Economics themselves aren't actually affecting financial markets at the moment. It's interest rates. The blue line on the slide in front of you is the S&P price performance over the last 15 years, and the green line is the economic growth of the US. Before the financial crisis, it was a key driver of asset prices. Since the financial crisis, it really hasn't borne much effect on the price action. In fact, it's been the price of money that has been the big driver. We saw a similar chart in the first presentation. And therefore, when we think about economics, we shouldn't be thinking of the impact on financial assets. We need to think about it as it impacts the monetary policy of the Fed, the Bank of England, the ECB, the RBA, and so on. My presentation will be talking about that, the timing of these rate rises, how far they go, and the impact on financial markets. So we're in an accommodative policy, and I just need to start with what the theory of this is. The idea being that in the bottom left-hand corner of this cycle, the economy tries to move back to full employment. As it does so, wages rise. Because interest rates are so low, we choose to spend our new money rather than save it. Because we're spending that money, we're growing the economy, we're generating jobs, and we create a nice cycle. And the central bank only needs to stop that accommodative policy if we're buying so many goods, we're actually driving up inflation. Now, it just isn't happening. This particular piece of theory isn't playing out. The top chart on the slide in front of you shows in red the unemployment rate, the one that's quoted in the press, the one that's used by the Federal Reserve. And on the surface, it would appear that the unemployment rate is returning to normal levels, and in fact is pretty close to an equilibrium level of employment. But as Ron has pointed out, the unemployment rate, when referenced as the number of people out of work divided by the population of the states, that's the blue line, there's barely been any improvement since the financial crisis. And the reason for that is, in fact, what's happened in the States is that the proportion of Americans making up the labour force is dropping. The green line in the bottom left-hand slide shows you what we call the participation rate, which is the proportion of Americans who are part of the workforce. You can see that since 2008 there has been a gradual decline. Now what's interesting is when you look at male employment, really since the end of the Second World War there's been a gradual and consistent decline of the proportion of men who consider themselves part of the labour force. And incidentally, this is if you're working or not, it's just that you would consider yourself eligible for work if there was any there. Janet Yellen is saying there's something new with this economy, we need to worry about it differently from the past, and she would point to data like the red line. The red line is the proportion of women who consider themselves eligible for work, and you can see from 1950 to 2000 we saw the social change in the role of women in the workplace in America. So from 30% up to 50% of women making up the female workforce. That, for the first time ever, has started to drop since the financial crisis. Yellen would say something is going on, we have a new type of economy. On the right-hand slide is the amount of time you're out of work if you lose your job. Prior to the financial crisis, someone on average tended to be out of work for between 10 and 15 weeks. That has gone up to almost a year after the crisis. And again, Janet Yellen has said this must be doing something different to the US economy. It must be damaging confidence of the consumers. Even if you find your way back into work, you're going to not spend so much because you're nervous about the stability of your work. And so she argues she should hold back on rate rises. And this would be the one in James's camp, which is there is a fear of deflation out there. The other side of the coin is this economic theory about using unemployment, about using growth. It's been around for many, many years. The red line on the slide in front of you is something called the Taylor rule, which is a conversion of economic growth and unemployment into an interest rate. The Fed use it religiously. And you can see that the blue line, which is actual interest rate, maps it very closely until we came into the financial crisis. The red line went negative. The Federal Reserve couldn't set negative interest rates. So they correctly, according to this model, embarked on QE. And in fact, the red lines come back to zero. They correctly tapered. But you can see the area I've circled on the slide there. That's around about 2013. According to this traditional model, the Fed are late in tapering. And the hawks that we've just referenced from the FOMC, they would say, this is crazy. We're only 0.5% away from trend employment. We're only half away from target inflation. We're running at above or near trend growth. We couldn't be, why are we buying bonds still? Perhaps a zero interest rate, but why are we still buying bonds? And in fact, the red line now is suggesting the interest rate should have risen a while back and should now be above, or at least 1 or perhaps even 2%. And those that are arguing the inflation story are saying rates are way too low. And Yellen has an ever-growing problem that she has to try and persuade the market she's going to keep rates low with pressures like this building within other members of the FOMC. Well, why haven't yields risen? And I'm now going to switch from economics into financial assets. The reason yields didn't rise in 2014 was because they were already quite high. Now, I know everyone's going to sort of scoff and say, well, how can you possibly think 3% is high? 3% is a high yield relative to a zero Fed funds rate. It's what we call the slope of the curve, and it's incredibly steep. It still is. And it's steep because the market is already pricing in the likelihood of these rate rises. And therefore, it's hard to get further yield rises from here without first getting actual rate rises. And for this reason, we're quite comfortable about the 10-year US Treasury yield staying these levels, or perhaps a fraction higher for the remainder of this year, and not making any meaningful rises until we get into the middle of 2015 when the Fed funds rate rises start. For me, the question is not where or when rate rises start, but how far the rate rises go on for. That will ultimately drive the level of US Treasury yields and indeed beyond that equity pricing. Now, the red line on the chart in front of you is the average level of Fed funds rate from the start of fiat money right through to the financial crisis, and on average, the Fed funds was around about 7%. The column of data you see on the table, the first column, is the level of inflation over that period, around about 4%. Population growth is about 1%, productivity just under 2%. You can sum all that up to get a normal level of short rates, and it was about 7%. Now, we've heard already from the previous two speakers, inflation won't be at 4%, even if we get a bout of unexpected inflation. The Federal Reserve are targeting 2%. That's their formal definition of their monetary policy, in the same way the RBA has a definition, so the Fed does. Let's assume, in a pessimistic but plausible case, that they miss that target by, say, 0.5%. As Ron has mentioned, the population growth is scheduled in the US to be about 0.5% over the next century, lower than in the past. And productivity might be considered to be lower in the sense that we've just come through a very significant technology evolution. So perhaps we only get to 1% productivity growth in the States. None of these are ridiculous numbers. You sum them up, and it puts the terminal level of interest rates in America at 3%. That's where the Fed would stop raising. That's where they would say they've got back to normal. Now, our central scenario is fractionally higher than that. We're at 375. But in any event, we're talking about much, much lower numbers than we've seen in the past. And because of that, one has to be very careful when one talks about a yield-rising environment. I do think yields in the US and around the world will rise, but I think they will rise very slowly, and I don't think they will rise very far. The orange dotted line on the chart in front of you shows you my projection of the US 10-year yield if the Fed starts normalizing in 2017, takes 10 years to get back to normal, and ends up at a level of 375 in Fed funds. So I know everyone's fearful of a yield-rising environment. I think they're right to be fearful in the sense that it probably will be a yield-rising environment, but they're wrong to be fearful because it will only be slow and very gradual and not particularly high, and therefore the impact on fixed income securities is unlikely to be particularly big. Notice, incidentally, like the other speakers, we're a little bit doom and gloom. I'm expecting it to take at least 10 years to normalise in the US. What does that mean for credit? And here it is interesting listening to James this morning. I share some of his views. I certainly found it interesting to listen to the views. But where I'm slightly at odds with him is that argument could probably have been made 2 or 3 years ago, and the temptation, having listened to it, is to get yourself out of financial assets. And of course, we've had an enormous boost in both fixed income assets and equity assets over that period. So one can't just remove oneself from the market based on the risk that we talked about this morning. And converse to that, I think the issue is that with a lower than normal interest rate, actually the environment for risky assets remains quite attractive. So there will be a shock at some point, I'm sure, but the key for us as investors is to identify how long can we expose ourselves to financial assets for before that shock occurs. I would argue a little while longer yet. What I show on the slide here, in the top left slide, is the average risk-free rate in the States. An orange line is a long-term average. On the top at the right is the spread on corporate bonds, very high-quality corporate bonds. Now, contrary to folklore, very high-quality corporate bonds very seldom default. In fact, there's never been a default from a AAA. The premium you pick up as an investor in investment-grade credit is a premium for the illiquidity of the instrument. They don't trade as often as a Treasury bond trades. And you can see through time that the illiquidity premium has been about 0.75% and has stayed there since 1990 and beyond, with the exception of a crisis here and there. Now, when we've got 5% interest rates, an extra 0.75% doesn't mean a great deal to us. But if we're only going to have 0 and gradually go up to 3, all of a sudden that extra 0.75% is very meaningful to us. And I think that will be a driver of investors into the investment-grade corporate market for the years to come. Switching to high yield, a similar story. Because the monetary policy of the US is so easy, it is very easy for companies to refinance. And yet the economics of the US are okay. They're not fantastic, but they're okay. So companies are doing okay, and if they have difficulties with refinancing, they can simply go to the corporate debt market and borrow, because it's very cheap to borrow. And that means that defaults aren't going to rise for a long time to come. The dotted lines on the chart in front of you show a projection of where we see the default rate being in the United States for the next 10 years. And you can see in all cases, there's a bearish, a middle, and a bullish scenario. We see defaults dropping through till 2016-17 before rising again. And incidentally, if we have a Japanization where we have low but not negative growth but zero interest rates, that's very positive in the medium term for high yield because refinancing is so easy. So again, I'm fearful of the Armageddon case that we sort of heard this morning, but I do think that's a time ahead, and I wouldn't be encouraging removing exposure to risky assets just at the time being. I've got no minutes left. I'm going to very quickly cover Europe and the UK. The UK I'll start with first of all. The UK is a very interesting market because it's likely to be the first to raise rates. And so we will see in the very near future exactly what the impact is on consumers from rate rises. And in the UK, like in Australia, we all have variable rate mortgages. And in the UK, it's instantaneous. When the central bank raises its policy rate, we get a letter from the bank saying your next payment will be going up by this amount. So we as UK consumers will feel the brunt of a rate rise immediately. And I think that even if you aren't investing in the UK or it's not an area that you particularly look at, it's going to be a very good leading indicator for how easy it is going to be for bigger markets like the US to commence their rate rising cycle. Europe, on the other hand, looks more and more like Japan every day. I don't think that we'll see rate rises there. I'll go even further than that. I'll put my neck out. I don't think we'll see rate rises in my working career. It's looking more like Japan. You can see on the left-hand slide, we've estimated where we think the normal interest rate in Europe is. That is the level of interest rates when we've finished a rate rising cycle. We've got it in a plausible but pessimistic case at 1.5%. That's the same as Japan. And one of the reasons it looks more and more similar to Japan is that we are seeing population shrinkage. And as your population shrinks, your trend level of growth must go down. And what we've really seen, you see the blue line on that left-hand panel there, that's the market's projection of interest rates in Europe. I deliberately put this stale chart in, it's of April of this year. The price action we've seen in Germany since then, in Bunds, has moved that blue line down to the red one. The market has priced out the idea that Europe is going to make a recovery and instead is going to move to more like a Japanese long-term, zero interest rates, very low inflation, low potential growth. The final chart I'll show is the Taylor rule. You've just seen one for the US. Just to reinforce my point on Europe, one of the great benefits that Europe has is it doesn't have to engage in forward guidance. It doesn't have to persuade the market it's going to hold back. The red line you can see here, the dots show where we expect the interest rates to go according to economics in Europe. The blue line is where the market thinks it's going to go. They're right on top of each other. So all the ECB has to do is just to sit tight, keep on zero interest rates, potentially do more QE. I'm not sure they need to at this stage. And just wait time out. And in fact, one of the reasons why Europe has been much more sluggish than the rest of the world is the reality is they only went to zero interest rates last week. It took them 6 years longer than the US to get to zero interest rates. And it's easy to forget. You might recall in 2011, Europe actually tried a rate rising cycle and put 2 rate rises in, then quickly reversed them. So the fact is that Europe just hasn't been anything like as accommodative as was required. And they're behind, and therefore I think it's simply just waiting a matter of time, and by time I mean many years, for the European economy to pick up. The best hope for Europe is that the US picks up, raises rates, that causes the dollar to strengthen, euro to weaken, and we get the currency war scenario that we heard about in the first speaker to help the Europeans out. Thank you.